How futures leverage works. Leverage and margin in futures. Futures contracts are a leveraged product. This means that it is possible to control futures contracts with a large face value by depositing a much smaller sum. This deposit is known as margin, and it is a good faith deposit that is debited from a trader's brokerage account and held by the clearinghouse of the futures exchange, which acts as an intermediary in all futures transactions. This allows participants to act without the need to perform due diligence on counterparties. Because the clearinghouse acts as a financial guarantor to both buyers and sellers of futures, participants are required to post and then maintain margin, which acts as a performance bond, to ensure that both parties are able to fulfill their obligations upon termination of the contract. 1. Unlike leverage in other securities such as stocks, there is no loan extended in order to cover the remaining balance on the contract value of a futures position, as no actual purchase of any asset or commodity occurs with, and so no interest is payable, as a result of trading futures on margin. Margin requirements are specified by the exchanges and are dependent upon the contract's trading price and its volatility. It is normally necessary to post performance bond margins of between 5 and 10% of the contract value. 3 types of margin requirements. There are 3 different types of margin requirements that are commonly specified, and the distinction between them is important. Initial margin. This is the amount that must be deposited in order to initiate a contract and open a position. It is specified by the futures exchange. Maintenance margin. This is the amount that must remain on deposit once any trading losses have been accounted for, and is typically around 80 to 90% of the initial margin. Traders' positions are marked to market by the clearinghouse at the end of each trading day to make sure there is sufficient margin in the account. Day trade margin. Because the clearinghouse is only concerned with margin at the end of each trading day, the requirement for margin during the day is set by each client's broker and managed internally by the brokerage house too. It is common for futures brokers to specify that a stop-loss order must be in place for all positions using day trade margin. Day trade margins are much lower than maintenance margins and allow a much higher degree of leverage to be used. By the end of the trading day, all positions must either be liquidated or sufficient funds provided to meet the maintenance margin requirements of the exchange. Margin calls. A margin call is simply a message stating that more funds must be provided in order to meet minimum margin requirements following losses on an open position. A margin call may come either from the clearinghouse, communicated via the broker to their client, in the case of maintenance margins, or from the broker in the case of day trade margins. If a margin call is not met with the immediate deposit of further funds, the open position will be liquidated on behalf of the client. How is margin calculated? There are a number of factors that are taken into consideration by an exchange's clearinghouse when deciding on the margin requirements for a product. These normally assume that a portfolio of different contracts will be held, and then stress test a hypothetical model portfolio, known as the span portfolio 3, to determine the worst possible loss they might suffer in a single trading day. Variables that are considered include contract price, volatility, correlation with other markets, liquidity, and daily price limits. Because market conditions are in constant flux and margins must be effective in different environments, exchanges are faced with several options to keep margins low and update the requirements regularly, or to set margins at a higher rate and seldom change them. Margin changes almost never occur during regular trading hours, as the exchange is not able to make use the latest liquidity data during a trading session. Most exchanges provide at least 24 hours notice of impending changes to margin requirements. Leverage and risk. Leverage serves to magnify both losses and gains. Although a trader may have deposited just $5,000 in order to open a futures position, this position may be in a contract that is worth $100,000. Because the contract is worth 20 times more, the losses or gains will be 20 times more than as a position was taken in a contract worth $5,000 without margin. The possibility for large losses and gains relative to the margin account size means that leveraged futures are significantly more risky than traditional investments. Unlike with other securities, where leverage trading may exist as an option for investors meeting certain requirements, leverage and margin are an inherent part of how futures markets function, and leverage is a built-in characteristic of these derivatives.